Hello and welcome, and thanks for joining the I Invest webinar. I am Philip Williams. For some of you who follow, thank you very much for following. If it's the first time that you're joining this webinar or somebody told you about Fill the Gap, um, I'm Phil, the founder of Fill the Gap, and Fill the Gap is a company that really was started to help you find and fill the gaps in your financial knowledge so that you could take comfort and feel confident with the decisions that you make with your money. And I know time is very precious, so I don't know what you would normally be doing on Thursday evening at 6 o'clock or 6:30, I should say. But I'll say this, to the extent that you've carved out time to get your level up your investment education, you're already setting yourself apart and you're already making a decision that is in the positive or the right direction for your financial journey, right? So I know, yes, of course, it's obvious that you want to learn more about investing. You want to start investing, and that is exciting. But I think more than that, if you dissect it, if you really think about it, you may have some very important questions. You may want to know how best to manage your finances, and how you can just get more out of life, make the max with what you have. So by you choosing to invest in yourself and being here today, again, I just want to say thank you very much for joining the Fill the Gap I Invest webinar. We're almost into the month of May, which means, we actually almost halfway through 2026. So it's a great time to take stock. You may have had financial goals at the beginning of the year. You may be on track. You may have fell off, you may have fallen off track sometimes, but it's a great time certainly to consider or take stock in terms of where you are at and how you want to position yourself for the remainder of the year. You may have specific issues or worries or burning questions when it comes to, in relation to managing your money, right? Thing about this, a lot of times I think you might feel as though you're not happy with your money journey, but a lot of times you may be doing a lot better than you actually know. And sometimes when you think about money, I guess the natural thing or the natural question would be like, okay, well, I just, feel like I need more money. And I hear that, but I would want you to consider, just understand, if you can't manage these small amounts of money, when you get large amounts of money, it's going to be, you're probably going to end up in the same pitfalls or making those types of decisions. So many times you may hear about lottery winners and people who have large sums of money, and you probably wonder how they can fumble it, but that can happen, right? It can happen. And so you may find yourself right back where you started. So it's important to lay a foundation. Certainly to be laying a foundation before you start investing. So with that in mind, I do have a question for you to ponder. Just think about, do you know, so I know we're going to start talking about investing, but do you know where all your money goes? Do you know exactly how are you tracking your spending? And if you do, that's great. That's a very, very solid start for your financial journey. And if not, don't beat up yourself. Don't feel too overwhelmed. There are things there are tools available that you can use to change that and change the outlook of your finances. So before we get into the exciting part, which is investing. I just want to run through the five PTG pillars, and PTG stands for Fill the Gap. The first pillar is budgeting for your life. Your life meaning not someone else's life, the things that you want and the goals that you are working towards. Saving with a purpose, that's the second pillar. And a good example of saving with a purpose, and one of the first things that you should be saving for, is an emergency fund. The third one is managing your debt, because at some point, some of you have credit cards, some of you may have loans with the bank, different types of loans. Some are a bit longer than others, but it's important to know what type, how loans work, how interest rates work, and how they can impact you over the long run. So it's very important to manage your debt. Certainly setting smart financial goals, not just putting your money or putting your dollars in places where it's not benefiting you the most. So you have to know exactly where you are positioning your finances. And once you have those four pillars on point and in place, this is a good place. It's a good base, right, for you to achieve your big life goals. And that's a great place for you to know that you can start investing. Because sometimes, sometimes it may not be the best time to start. And doesn't mean if you're not in a position to start today, it doesn't mean that you can start in the next 6 months or you can't start in the following year. But I will assist you and give you the tools to know if it's, now is a good time for you to be investing, right? So I just want to remind you of the five pillars, right? So today, yes, we are focusing on investing to create wealth, which is the fifth pillar. But I do want you to make a mental note, or better yet, make a note on your phone. The four pillars. Think about some of the gaps that you may have, the knowledge gaps when it comes to budgeting for your life, saving with a purpose, managing your debt wisely, and setting smart financial goals. And again, if there are gaps, know that you are not alone, and there are things that you can do to rectify that, which I'm going to share with you. And you just have to resolve or be very deliberate after this session moving forward that you're going to take steps and do the things that are required and needed for you to close those gaps before you start investing. Before we start, I just want you to tune into think about how you feel about investing, how you feel about taking savings, money that is safe, and putting it into the stock market. There's a lot of things going on happening in the globe right now, geopolitical risk, and that can be scary. But think about how you feel. Maybe write it on a notepad or even drop a comment in the chat if you're brave enough, and then just think of one word of how you feel about investing. Reminder that we're all at different stages in our financial journey, right? So where you are, someone else may be at a different space. Someone may have a different risk tolerance, in terms of how they feel about taking risk and investing in the stock market. But what I do want you to know, if you have ever had that thought, that, well, investing is for wealthy people or for the people who are professionals. If that's what you're thinking, I trust that by the end of the webinar, your thinking would shift, because investing is for you. You can invest too. And that's my aim for you by the end of the session. So now I'm just going to share the presentation. And I guess I'm hoping that someone can also just put up your hands and just confirm that you're seeing the presentation when it's up. Okay. All right. So I'm seeing, yes, you raise your hands. Okay, great. So this is the session today. It's really a blueprint, really a framework for you to begin to understand the options that you have in a very contextual or practical way, not just, on, things that you might see on the international market, but particularly things that are available to you here in Trinidad and Tobago that you may not be aware of, or you may be interested in, and be just because of lack of knowledge, you're intimidated and you kind of hold yourself back from starting. Okay, so that is the presentation today. I know that, and again, this is understandable. The natural instinct and the emotions that come with money, it's very, I get it. You want to double and triple your money very quickly. And there's an emotional side to that. And there are actors in the market who are not professionals, who are very dangerous people. Sometimes from time to time, you would see people will rip pictures from my social media, make their own pages, which is part of the reason I'm not as active on TikTok, because TikTok is a very different space and a little difficult to manage. So I had to scale back on that. But the reality is, somebody is going to reach out to you, tell you that they can double or triple your money, tell you about this investment that is so good to be true. And if you miss out on it, you have to do it now. Anytime you hear anybody pressing you to act immediately, that's a huge red flag. Also know that anytime you see fill the gap, reaching out to you or soliciting or asking you for any money, you know that that's somebody trying to scam you. So investing is, you have to think about it, the route or the journey towards investing. It is very diligent and very disciplined, because before you know it, 6 months turn into a year turns into 3 years, and then you have a whole long-term horizon. It's 5 years in. So that's why, so when you think about investing, don't think short-term, don't think, putting in your money and it's just going to automatically double. Think about putting your money towards an asset that is going to generate income for you, it's going to generate growth for you. And please, please, please be mindful. This is something that people always have to be reminded of. Some people, you might be sitting there and saying, Philip, I don't understand how someone can get caught with these things. And that's fine. But I can tell you that it is very easy because these people are very, 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 very skillful. So it's easy with the technology that's available, all of the technology that's available for people to con people out there. So that's what I'm urging you. It's not about doubling your money and tripling it overnight. It's about being deliberate and being very disciplined. And if you are not sure about someone or not sure about an investment, reach out to an investment professional to get the right answer. Okay? So where I'm gonna where I'm going to right now is really just to start off by saying that I always remind you, if you follow Fill the Gap, that there are many places where you shop. So if you have a loan with any one of these banks, right? And no, this is not an advertisement. This is me listing some of the companies that are listed on our local stock exchange. Because if you have, if you've purchased or used any one of these services or products, then you have contributed to the profits of these companies. And I want you to know that you don't only have to be a consumer. You can be an investor as well, and I'm going to show you how you can do that. So if you have a loan with Republic Bank, Scotiabank, First Citizens, the interest that you pay on that loan, because loans, that's the brick and mortar of, that's how banks make profits. And I'm never, not knocking the banks. The banks provide a service, an invaluable service. You just have to know how to utilize that service to the best of your ability. And if you do have loans with these banks and you have an opportunity to invest, then you should be thinking about that. If you shop in any of these places, if you drinking alcohol, these companies generate large amounts of profits and they do share these profits with their shareholders. So there's an opportunity for you to not just be an investor and a consumer, sorry. There's a pathway for you to become an investor and share in some of the profits that you give, generate for these companies. Now, in terms of the types of assets, so what I was talking about there was stocks, which I'm going to go explain right now. The companies that I had up there, the places where you shop, how you access those companies is on the TT Stock Exchange, which is located on Independence Square in the Nicholas Towers. Right? Now, stocks, you think of stocks, or want you to think about stocks, you are an owner. So when you purchase or you buy a stock, you are a part owner of the stock, whichever stock that you buy. And owner meaning if the company decides to pay dividends, which is a share in profits, you are entitled to a share in profits once dividends are declared, as well as so I'll give you an example, sometimes when the stock market is going up or stocks are going up, that's called capital appreciation. So if you think about buying a stock for $5 or let's say simple, $1 and it moved up to $1.50, then that is growth. So those are the two ways that you can earn with a stock through dividends, which are sharing profits, and by the stock increasing because people feel as though, I feel comfortable with what the management of this company is doing. I feel comfortable because this company has been around for decades. I feel comfortable because I see, I have an opinion, whether you got it from a professional or if you have the ability to do that in terms of looking at a company's financials and determining. And sometimes that may be a bit daunting, but there are people that do that, which I will explain. But it's really getting an opinion in terms of, is it worth investing in this company? But that is how you earn through buying stocks. That's how when you move from being a consumer to being an investor. I will point out that there is risk in the stock. The stock market moves up and it moves down. And usually the temperature of an economy dictates in general, doesn't happen all the time, what's happening in a stock market. Meaning, if an economy is doing really well, like economy is booming and it's growing, it means that people more than likely have disposable income. It means that companies are generating profits, balance sheets are very healthy, profits are growing, and that is very exciting for investors. And that's what causes stocks to go up. But the opposite of that is when economies are not doing well, doesn't mean that you have a bad investment, but it means that, the stock prices can go down. So generally, stock prices fluctuate over time. So there is risk involved when you're investing in stocks. The best candidate for investing in the stock market. If you are thinking about long-term growth, if you are thinking about your pension, if you have a child that you want to save for their education, if you have a child you want to leave a big nest egg for them, this is the best type of investment. So if you're thinking about growth, stocks are best for that. Bonds, in this instance, you are a lender. So a bond is a safer asset. It's a fixed asset. When I say fixed, um, the interest that's paid on bonds, it's fixed. So meaning that you are not guaranteed, companies are not guaranteed to make profits every year. So the profits do better some years and sometimes they might have less profits. But with a bond, things are fixed. It's a contractual agreement. So the risk is lower. And this is better suited for somebody who's seeking to preserve capital and just wants steady income. So that's stocks and bonds, which are the traditional type of assets, right? Mutual funds, again, this is you're pooling your money, you get a return because someone manages the money, but there are different types of mutual funds and ETFs, similar to mutual fund, but they trade on stock exchange. So a good example of what an ETF is, an exchange traded fund. So think about a basket of stocks or stocks and bonds, but it's not like you're walking into a building or you're going in to buy whether it is shares or units. It's not that. It's traded on a stock exchange. So a good example of that, the most recent example would have been, if you're familiar with the stock exchange, one asset would have been the Calypso Macro Index Fund. That was an index fund similar to an ETF, and it was traded on the stock exchange. So you would have to go to a broker to get it, which I will explain later how you can do that, right? So those are the traditional assets. Just getting in a bit deeper into, what is a bond? How does it work? Why are bonds issued? Just explain this to me, Phil. What really is a bond? A bond is a contractual agreement and it's a form of raising capital. So governments raise capital as well as corporates raise capital. So some of the companies that I would have shown you before, where that have stocks, they also borrow money, and that is a corporate debt or corporate bond. But they're government bonds and they're corporate bonds. And the reason for issuing a bond is to raise capital. So governments will raise capital to build roads, build bridges, or maybe pay salaries. It just depends. Um, Governments borrow for different reasons. Corporations borrow to expand, buy computers, purchase another company in another part of the world. It just depends. So borrowing, just think of the way when you go to the bank to get a loan for a car or house, think of a bond like that. In this case, when you hear the issuer, if issued by the government is the borrower. The people that invest in the bond are the lenders. And again, is to generate funds for various reasons, and the bond is purchased by an investor. And principal is paid back. So P, the coupon, that's just the term for the interest that's being paid, which is fixed. So if you hear a coupon is 5% or coupon is 7%, it just means that that's the annual rate that's being paid on a bond. This is a real example of natural NGC, right, which is the natural gas company of Trinidad and Tobago, an actual bond that is in the market right now. The principal, which is the amount that NGC borrowed, is 400 million US dollars. The maturity date, which is the time that the bond has to be repaid. So in different types of bonds, you can have a 5-year, 10-year, 30-year bond. This bond is going to be repaid in 2036. So that's the length of time. Investors who are in this bond receive coupon payments or interest semi-annually, and the coupon is 6.05%. So this is a real bond that is in the market right now that I figured I should use and show you as an example of what is available. This is just one example. There are many different bonds, corporate bonds and government bonds out there. But I just wanted to give you a framework. The next time you hear bond, just think of it's a fancy word for saying a gigantic loan, and somebody needs a lot of money to do something major. That's what a bond is. Um, so stocks, which I explained earlier, companies. So there are two ways of raising capital. The other way of raising capital is by giving a share of your company. So let's say you had this company, and let's say you had your mom and dad had a parlor, this parlor grew so big that you want to turn into a supermarket. And then it turned into a chain of supermarkets. And it was so big that now you need capital, and you went to the bank or went to bankers to put this company, put some of these shares and make it available for other neighbors and other people to invest in. So when companies want to raise capital, they put their shares on the market for people to invest. It's a form of raising capital. It's giving up ownership. So whereas now you may have had 100% ownership, now you might have given up 10% or 20% and put those shares out there for individuals to buy. And now these part owners have an opportunity to earn if and when you do make profits. So yeah, that's it in a very layman, simple terms. The companies that I was showing you earlier would have placed shares on the market. And usually they have big banks and lawyers who would arrange these deals. That's called an IPO when a company is putting shares on the market, which is an initial public offering. Or if they're putting more shares on the market, that's an APO, an additional public offering. So, some of the more recent ones you might have seen Solis, you might have seen Medcorp in distant past, you might have seen First Citizens when they put out additional shares. So companies do this from time to time, and it is a form of raising capital. So those are the two ways: debt via bonds and stocks. And when investors purchase these shares, they are owners. They are a fraction or part owner, and you receive money as well as the stock price can grow. So you have an opportunity for your 50 cents to turn into a dollar, or or your dollar to turn into a dollar and 50 cents, and you have an opportunity to earn dividends or profits on that dollar and 50 cents. So it's a great way for investing for the long term. So this is what stocks, just what stocks are. And let me say, let me check in my time. I I know that we do have a hard stop at 7:30, so I'm going to do my best to answer all of the questions because I know you may have some questions, but I think it's best to answer the questions at the end. So this is the stock market, the TT Composite Index and the All TT Index. So All TT meaning just only companies that are registered in Trinidad. TT Composite meaning so there may be companies like NCBJ, Grace Kennedy, and other companies that in Jamaica, domiciled in Jamaica, but they have business and they're listed on our stock exchange here in Trinidad. So this is really tracking the stock market over a very long period, to about 20 to 30 years. Just you may not be able to see the legend properly, but really what this chart is saying, you may see the ups and downs, but over time, in general, what stock markets do is they trend upward. And I just use this example of Republic Bank. If you invested in Republic Bank, remember I said earlier, if you're thinking about retirement or you're investing for a child, investing again, so I must say this here. This is not a recommendation to buy Republic Bank stock. This is not investment advice. And I have to say this, so to be careful. This is an example of a real example of what has happened in the past with Republic Bank, and past performance is not indicative of exactly what's going to happen in the future, but it certainly gives a gauge of the possibilities. This is the return if you're investing. So maybe if you might probably be saying, boy, wow, maybe my parents should have invested in Republic Bank 30 years ago. But it's like the big picture it is if you do have kids and if you are thinking about your future and future growth, then you should be entertaining the idea of thinking about investing in the stock market. This is just an example of the possibilities of what can happen over the long term with a stock, right? Right now, this is actual data in terms of what are the top performers this year on the composite index. So for the year-to-date return is 1.95%, right? And let me just say, so I know everybody's going to zero in on, so this is year to date from starting from December 31st, 2025, at the beginning of the year, to April 22nd, 2026. These three companies here are the top performers for the year. National Enterprise, TTNGL, National Enterprises, and Flipdeco. I know there's a lot of excitement around TTNGL And if you are an owner of TTNGL or you've been following, you know that TTNGL was under tremendous amount of pressure. So the stock went way, 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 way down. There are a lot of people who bought at the IPO, which was somewhere around $20 or upwards of 20 something dollars. And the stock went down. The reason for that is, doesn't mean that it's a bad company or a bad investment. Companies like TTNGL, the price and the performance is linked to what is happening in the energy sector. So it's linked to the price of gas. And the company has had issues in the past, mainly because of gas supply in Trinidad and Tobago, which is expected to change in 2027. So the outlook for energy certainly looks a lot better than it was a year, 2 years ago. Well, I know everybody's following what's happening around the world. So the price of oil does impact gas prices overall. When oil prices are going up, gas prices go up as well. And that is indicative of the potential for a company to generate revenue. Just let me just say, if you missed my post on TTNGL, you should have a look at it. I did explain why the company was performing. It was because of an impairment, and an impairment is really think of you buying something, a company having an asset, and over time, the asset is not worth what you bought it. So you bought it for $1, now it's worth 50 cents because for different reasons. And in TTNGL's case, it would be because of Phoenix Park, which is that asset that drives much of the revenue. And so the impairment was because of, the expectation for future cash flows, which were a lot less, as again, mainly because of gas supply. So people who invested in TTNGL at the beginning of the year would turn out to be, at least today, a big winner. What happens going forward to the ending of the year? What happens in 2027? I will be careful because one is call is recorded, and two, because I work for an investment company, so it cannot be said. Everything that is being mentioned here today is an opinion of Philip Williams representing Fill the Gap. But I still also, even though I'm representing Fill the Gap, I have to be careful in terms of there are no guarantees with stocks. There are no guarantees with, as I said, past performance. It depends on what may happen it doesn't mean that that's what's going to happen in the future. But what I would say is, in a situation like this, what you have to look at is what are the prospects for energy in the future? What does the gas supply situation look like for Trinidad in 2027, moving forward to 2028, 29, 2030? And that should be the base of what is guiding you before you make a decision, right? In terms of, just let me touch on mutual funds. Mutual funds, which I mentioned earlier, you are pooling your money together. You have a professional money manager selecting these securities, doing all of the hard work. So I would have mentioned looking at financial statements. You have analysts, portfolio managers who that's what they're trained to do. And they make investment decision based on the work, based on the analysis. And that's how assets get selected to go into a portfolio. So it's a pool of assets pooled together and a pool of investors, and the money that is generated. If it's a stock portfolio or stock equity shares are the same thing. It's an equity portfolio. Those types of funds perform better, or actually perform better when the economy is doing better and your prospects for growth are a lot higher, as opposed to a bond ETF, which is more anchored in stability and a bit more conservative. But the important thing to recognize with a mutual fund is that you're pooled together with other investors, and you have an opportunity to get access to all kinds of different assets, like the bond that I mentioned. You may not be able to just go on the market and buy an NGC bond, but a mutual fund holding an NGC bond, getting that 6%, 6.05%, amongst the other assets that are there, that's what's passed on to you. So that's what a mutual fund is. There are different types of mutual funds. So there are money market funds, which are it's ultra conservative. So you're looking at anywhere between 1 to 2%, sometimes less than that. That's for a conservative investor. That's where you save your emergency money. That's where you park up money that, it parked up for a while, but you might need it in 12 to 48 months. You put it in a money market fund, or it's money that you've saved for quite a long time and you're moving, say, heading towards retirement. You might want to start reducing your risk and taking your money out of stocks to put it in a money market fund. A fixed income fund will have more risk. So money market do usually have instruments that they are fixed income, but they mature in less than a year. Fixed income meaning they are bonds. So the bonds could be 3, 5, 10, 30-year bonds. That's it's also it's a safer investment, but you're taking on more risk because of the length of time. So the longer time money is being loaned for, the bigger risk that things can happen, right? So just think of borrowing money for 1 year, lending somebody money, a family member or anybody for 1 year versus lending them for 5 years or 10 years. So that's the difference with these two types of mutual funds. A balanced funds, that someone says, hey, I want to take some risk. I want to get a little portfolio to be a little bit safe, so I want the best of both worlds. This is a perfect example for you, a balanced fund where it's 50-50 and your returns can be, now these returns here, this is long term and this is a balanced fund that probably has a little more equity in it, so not necessarily 50-50. These returns here, let me be clear, again, are not also guaranteed, but general historical performance has shown these are the types of returns that you do expect on a stock portfolio, which is the majority is in equity. This is the type of returns that you are looking for over the long term. If you're thinking about long term, meaning anything 5 years and beyond. So these are the different types of mutual funds that you can select. And it's very important when you go into any CSR, any sales rep, ask them the questions you need to ask. Don't just open a product because somebody is pressing you. Don't just open a product because their job is to sell. Their job is to nag you. Their job is to get the money out of you and open an account. And you have good sales um, people out there. So I'm not knocking any particular. There are good sales people out there, and then there's some who their interest is really just in selling, and you have to be careful because you don't want to buy a product that is not aligned to the goal. So it doesn't mean it's a bad product, but it's not aligned to the goal that you have. So if somebody tells you to open a money market fund, but you're thinking about long-term growth, then that's bad for you because you're not positioned appropriately. If you're thinking about being conservative and somebody recommends an equity fund, that's bad for you. That's not the right advice. So it's very important to know what's in the portfolio, any type of investment product that you are having, so you know where you are on the spectrum in terms of risk. These are just an example of some of the funds that are available in Trinidad. There are almost 70, so there are over 60 registered mutual funds, all having different variations of the types that I showed you, from low risk to high risk to medium risk. These are real examples of funds that exist in Trinidad. Again, these are not, this is not a sales pitch. This is not me making a recommendation, but these are funds that are selected that fall in a particular space in the spectrum. So you have the low risk money market funds, you have the medium risk balance funds. I just wanted to give you a real live example of the type of funds that are available out there in the local market that you can pick up the phone and call. You can send an email, and these people usually, proper sale, they respond within probably less than 24 hours and get all of the information that you need before you make a decision to go into any particular type of mutual fund. Before, I know we're talking about stocks earlier. So to access the stock market, so there are two things. You might say, well, Phil, coming out of this presentation, I am not sure too I'm not sure I'm ready to invest in stocks. Mutual funds would be the best for you because you get exposure to stocks and you have somebody managing the money for you. You might say, Phil, actually, you know what? I do want to start my investment portfolio and have stocks and have mutual funds and have, then that's so how you get access to some of the companies that are, or not some of the companies that are listed on the stock exchange, some of the places where you shop, you have to open a brokerage account. A brokerage account is like a bank account. So this usual know your customer stuff. There are 8 brokers. This is how a broker works. You open the account, you put money in the account, you give the broker instructions. You say, hey, well, I'm not a broker, but if I was a broker, you'd say, Phil, can you buy X amount of these shares for me with this $1,000 that I have in the account, or this $5,000. This can be done over the telephone, it can be done via email. The trickiest part, I shouldn't say the trickiest part, is getting the account open. And that's not tricky, but usually in Trinidad, I think it's a little more difficult than advanced countries in terms of the know your customer stuff. That could be frustrating, I know, but you just have to go through, we all have to do to just go through the paces in terms of what needs to be done. And a broker is the middleman, so there is a fee. So if you bought stocks and the stocks cost $100, a pool of stocks, the broker is going to charge you $1.20. That's the brokerage fee for an investment on so it's 1 to 1.2%. It depends on the size, but generally, brokerage fees range in that amount, right? So you deposit cash, you open your account, deposit cash into the account. The broker gets instructions from you, and they execute the trade on your behalf, and now you have the assets that are securely held. I will answer the question about Phil, how will I know what kind of stock to buy? I'm going to get to that very shortly. All right, so these are a list of the brokers, right? These are a list of the brokers here in Trinidad and Tobago. Not the some of them are not the actual, the logos may be a bit off, but NCB, JMMB, First, Wise, and Republic Bank, and Caribbean Stock Market Brokers and Shepherd Securities. These are a list of the brokers here, registered brokers in Trinidad and Tobago. A broker is a broker is a broker. They provide different services. It can range. The starting amount could be as low as 2,500 all the way up to 25,000. It just depends. These are things that you should, again, these are questions that you can email and you can ask. I've done posts in the past, but I can also answer the question and point you in the direction of a broker, which I'll explain at the end. But these are the brokers that are available. Now, just in terms of your readiness before you make a move to start investing. If you have high credit card debt, it may not be the best time for you to start. The first thing you need to do is pay down that debt. If you don't have any kind of emergency fund saved, that's tricky. That's a bad space to be in because you're not positioning yourself. You don't have the right foundation or an appropriate foundation to start taking risks because if an emergency happens now, you have to sell stocks or sell your investment to take care of an emergency. That's not where you want to be. And similarly, high credit card debt, because of how expensive it is, it eats away at, you might think it's affordable because of the little bit that you're paying, but the little bit that you're paying for a lengthy time is a whole lot of money, right? And if you're very, very, very risk averse, then you might really need to think about, well, I probably shouldn't be investing in the stock market. The only thing I would say about that is there's risk in not taking risk. And the long-term goals that you have, you're setting yourself back by not taking risk, right? The other thing I would say, if you have a credit card and you have maxed it out and you are paying the minimum balance, say $10,000, maxed it out, and you're paying $250 or $300, that can take you more than 10 years, close to 10 to be somewhere between 10 to 13 years to pay off because you're paying the minimum balance and you're going to end up paying more than three times, almost three times the amount. So in interest, you're going to be paying like double the amount in interest. So you end up paying somewhere around like $30,000. I don't have an interest calculator here to show you, but I've done posts on that. And the reason I'm zeroing on that point is because I don't want you to move away saying, well, take the credit card comment lightly about, well, pay off your debt first before you start investing. Make sure you have an emergency fund before you start. This slide is really just talking about how important it is to start and to start as early as possible. This here looks at someone starting at 30 versus someone starting at 25. And the reason I'm showing this, or 20, sorry, the reason I'm showing this is I know there's somebody on the call or the webinar, you may not be 20, you may not be 30. If you're 40, you can start investing. If you're 50, you can start investing, right? Chances are the amount of money that you're earning later on in life, it means that your contributions can be greater, so you can be a lot more aggressive. But starting as early as possible with what you perceive to be a small salary is a major deal. And this really just shows someone starting at 20 years old versus somebody starting at 30 years old. The difference is almost $1 million or $900,000. This is assuming that you're investing $1,000 each month consistently. You started with 1,000, not a lump sum. You just started investing $1,000 each month and averaging a long-term return. So this assumes that you were investing in the stock market over a long period. And your aggregate or your average return was somewhere around 8%. Average return on the stock market is long-term between 7 to 10%, 7 to 9%. So I just went middle of the road with this simulation. So the best time to start really is today. Well, what it should be yesterday, but this is the best time to start, right? Sorry. And I know it's sort of the question of, how do I know what to invest in? Where do I start? If I open this brokerage account, what can I do? So some brokerage firms provide investment advice, some of them don't. Investment advice comes with a cost. I do have my I Invest program that was launched which gives you access to getting access to a broker um, that will assist you in opening the account. It also gives you access to getting guidance to structure your portfolio. So when you purchase the course, that is what you get. And certainly what you want to think about when you are investing is you don't want to do this on your own. It's good for you to think about your education so that you can eventually do it on your own. But if you're new, don't be adventurous and don't take advice from people who if you're not sure what their background is, right? That's very, very dangerous. So this is an example of this is just a sneak peek of one of the modules or that from the I Invest program. It gives you an idea of what you can expect. And then after that, we could pause for questions.
Now that you have an understanding of the various financial assets, the risk associated with these assets, and how to determine the health of these assets, it's time to build your portfolio. The traditional approach to constructing a portfolio consists of 6 steps. Number 1, conducting a constraints analysis to get on top of your financial situation. Number 2, figuring out what your investment objective is. Number 3, determining the right asset mix, so that's the asset allocation, to achieve the objective. Number 4, selecting the assets to create the portfolio. Number 5, reviewing your portfolio. And number 6, rebalancing accordingly. The primary objective of this approach is to strike the right balance between risk and return while achieving your investment goal. So step number 1, conduct making your first investment on the stock market might trigger a nervous feeling, but it doesn't have to be like that. Once you have the right team on your side, a solid investment team would be considered you, a reputable broker, and a qualified investment advisor. Stick up in right here. You might be eager to get going, but before you decide to start investing, it's important to determine if the timing is right for you. So, if you don't have emergency funds set aside, which is 4 to 6 months to take care of expenses to bail you out of an unforeseen circumstance, if you have high credit card debt, you have no health insurance, this may not be the right time for you to start investing. If you're in good financial shape, then you should not hesitate to open a brokerage account. You must have a brokerage account in order to purchase stocks. Stockbrokers are like the middlemen. They facilitate the buying and selling of shares on your behalf. There are 8 registered brokerage firms in Trinidad and Tobago. Here's a list of some of the brokerage services offered. Stock brokerage on the TT Stock Exchange, bond trading, investment advisory, mutual funds, wealth and portfolio management, portfolio analysis and management, personal financial planning research on equity and bond markets, the local, regional and international markets, access to international markets, and taxation services. Your decision in selecting a brokerage firm depends on the type of service that you're looking for and what you can afford, which could fall into 2 broad categories that can be described as full service and discounted service. Full service provides access to traditional asset classes, stocks, bonds, as well as a range of investment products and services such as mutual funds. The key feature with this type of service is professional investment advice combined with access to extensive research for clients who are interested. This service comes with an additional expense added to the usual cost of commissions paid for making trades. Commissions are fees charged by brokerage firms for executing trades on your behalf. Discount brokerages typically do not provide investment advice or extensive research. However, you have access to stockbroker services, possibly bond trading, and some basic research. In this scenario, you make your own investment decisions and give instructions to the broker regarding what assets to buy and sell on your behalf. The fees for this type of service are the key differentiator from a full-service brokerage firm, as the cost here is less. The main cost associated with this type of service would be the commissions. When selecting a broker, the following are some key considerations to be mindful of. Thoroughly examine the brokerage fees. It's important to review and understand the fee structure of a brokerage firm before you open an account to ensure that you are aware of all the potential costs involved. Doing a background check. Whilst commission rates are important in considering, when choosing a broker, it is also essential to evaluate other factors such as quality of the website, availability of research and portfolio management tools, customer support, types of accounts, and the overall reputation of the brokerage firm. If possible, you want to get references from customers to get a review of what their experience has been with the various firms. Once you've selected a broker, your investment team is almost complete. The only thing missing now is a trusted mentor or coach to guide you. An investment advisor. Investing in the stock market can get stormy. Sometimes, in rough seas, it's comforting to have an experienced captain. That's why, when starting out, it's best to have a trusted mentor or advisor, someone who is experienced in investing and aware of your personal investment goals. This could safeguard you from making unnecessary mistakes, preserve your hard-earned capital, and position you to build a solid foundation for success in your financial future. A good investment advisor has the requisite qualifications and work experience, has thorough understanding of financial markets. Recommendations are based on years of professional experience. That person undertakes all of the heavy lifting on your behalf, so that's the research and analysis. They will charge you appropriate fees for services rendered. They can provide access to tools that would build your investment knowledge. They also keep abreast of technological advancements in the financial landscape, and they're registered with the Trinidad and Tobago Securities Exchange Commission. Gentle reminder, investing is a team sport. So before you put your hard-earned cash to work in the stock market, it is in your best interest to ensure that you have the right players on your team. So when you're selecting your team, if something doesn't feel right, then you might have to look for someone else. It's important that you are completely comfortable with everyone who is on your investment team from the onset. Remember, investing is for you. You can invest too.